Hello and welcome to AI Market News by LM. Today, we're jumping right into a huge story that's sending shockwaves across the globe. The Japanese yen is, well, it's in a free fall, and it's hurtling towards a critical level that has traders and, you guessed it, central bankers on high alert. So let's break down exactly what is going on. Okay, look at this number, 159.69 yen to the US dollar. This is the number that has everyone glued to their screens. And let's be clear, this isn't just a bad day for the currency. This is the weakest the yen has been in over 3 decades. This kind of precipitous drop has set the stage for a really high-stakes standoff.
And that brings us to the billion-dollar question, right? With the yen in what really feels like a nosedive, are the Japanese authorities going to be forced to step in? I mean, to actually intervene and buy their own currency just to stop the bleeding? The entire market is just holding its breath right now.
So to really get what's happening, we need to understand why this 160 level is so darn important. You see, it's way more than just a number. It's become a psychological and historical battleground for the currency. It's a real line in the sand.
Now, what's so fascinating here is that we've been in this spot before. This chart of past interventions, it shows that Japan's financial authorities have defended this exact zone in the past. If we look back to 2022, they stepped in again and again as the yen got weaker. You know what they say? History doesn't always repeat, but it very often rhymes.
And it's not just us looking at history. Market experts are saying we're heading there again. A director at Mizuho Bank put it really bluntly, just saying that the yen hitting 160 is a matter of time. That pretty much reflects this widespread belief among traders that the fundamental pressures are just way too strong to ignore.
But here's the thing, this isn't just a Japan story, not at all. The yen's weakness is really a symptom of a much larger global storm, and it's being driven by this, well, toxic mix of geopolitics and economics.
Right at the heart of all this recent turmoil are the escalating tensions in the Middle East. With the war in Iran showing absolutely no signs of de-escalating, investors are doing what they always do. They're fleeing to the safety of the US dollar, which acts as the world's safe haven currency. And when money piles into the dollar, it directly weakens other currencies, like the yen.
Now, this conflict has a direct and pretty painful economic consequence: soaring energy prices. Brent crude, which is the global benchmark for oil, has surged back to around $100 a barrel. And a spike like that, it sends a shockwave through the global economy, reigniting all those fears of stubborn, persistent inflation.
And this right here perfectly illustrates why Japan is particularly vulnerable in this situation. Think about it. Japan has to import nearly all of its energy. So when oil prices just skyrocket, its import bill explodes, its trade balance gets worse, and all of that puts immense downward pressure on the yen. It's a vicious cycle.
But okay, the biggest driver of this whole currency move, it really comes down to policy. What we're looking at is a classic tale of 2 central banks, the US Federal Reserve and the Bank of Japan. And let me tell you, they are heading in completely opposite directions.
So let's look at the US side first. According to the CME FedWatch tool, the market is pricing in a 99.1% probability that the Fed will not cut interest rates at its next meeting. A 99.1% chance. With those inflation fears reignited by oil prices, the Fed is essentially locked in place. There's no wiggle room.
I mean, the shift in expectations has been absolutely dramatic. Just a few months ago, traders were betting on multiple rate cuts in 2024. Now, based on various news commentary, the market is completely priced out any cuts for this year. Some analysts are even suggesting we might have to wait until the middle of 2025. What a change!
So the crucial point, the real takeaway, is this contrast. On one side, you've got the US Fed, forced to stay hawkish. That just means keeping rates high to fight inflation. On the other side, you have the Bank of Japan, which is facing a sluggish economy, and that's pressuring it to remain dovish and keep rates super low. This massive difference in interest rates makes the US dollar way more attractive than the yen, and that's what's fueling this sell-off.
Now, these powerful macro forces aren't just contained to the currency markets. Oh no, the shockwaves are spilling over into stocks as fears of stagflation. You know, that ugly combination of high inflation and low growth really start to take hold.
And here's the proof in the pudding. We're seeing a broad-based sell-off in the US. The Dow, the S&P 500, the tech-heavy NASDAQ, all of them were down over 1.5%. This isn't some niche problem in one sector, it's hitting the entire market. To try and quantify the emotion behind this drop, we can turn to the Fear and Greed Index. It's a fantastic little tool that blends 7 different indicators, things like market momentum and volatility, to get a real read on whether investors are feeling fearful or greedy.
And no surprise here, the needle is pointing firmly in the fear zone. This just confirms what all the market data is telling us. Investors are spooked. They're selling off riskier assets like stocks and running for those safe havens like the US dollar we were talking about earlier.
So, after a week of some pretty intense volatility, what should we all be watching for? Well, the next few days are absolutely packed with events that could either calm the markets or pour gasoline on the fire.
According to investing.com, 3 dates are absolutely critical. On March 17th and 18th, we've got the U.S. Federal Reserve's policy meeting. Then, right after, on the 18th and 19th, the Bank of Japan meets. And to top it all off, on the 19th, we get the crucial U.S. core PCE inflation data, which is the Fed's favorite measure of inflation. The commentary from these central banks is going to set the tone for weeks to come.
And all of this leaves us with the final critical question. In this massive economic tug-of-war, with a currency in free fall on one side and a central bank that's determined to fight inflation on the other, which one is going to break first? This video is automatically generated by NotebookLM, an AI-powered tool. The reference sources used in this summary are listed in the video description. As this content is AI-generated, there may be errors in proper names, pronunciation, or unnatural speech. This video does not provide investment or trading advice. Please make investment decisions at your own discretion. Thanks for watching. Don't forget to like and subscribe.